How do cash flow problems usually start? Cash flow problems usually don't start with crisis. They usually start with neglect. Letting your accountant fully handle your money is kind of like letting your doctor eat healthy for you. It just doesn't really make sense. By the end of this video, you're going to know how neglect kills cash and how to steer our way out of it. Growing up in school, I was a bit of a tedious student, not tedious to studies, tedious to deal with. I was one of those students that I was just good enough to not be bad all the time. But I did cause plenty of headaches for enough of my teachers to be able to do it. But here's one thing I never got accused of. There was not one time on any scorecard that went over to my house that said, "Scott just pays too much attention." And that is a worldwide truth. Most problems don't start because we're paying too much attention. You know, one of the things we like to do in the world of small business and working together as small business owners is to illuminate some myths, to just call them out and to go, hey, let's call these what they are so that we can dive into a deeper level of truth. So I used a phrase earlier that said, hey, I let my accountant handle all of my finances. I'm going to give you some metaphors to that. When we hear that, we just cringe a little bit. Does that mean that your accountant doesn't do the task work, the transaction work? Of course. But knowing the dollars, knowing the money, knowing the past, the present, the future, the balance sheets, the P&Ls, the existing cash account, bank accounts, the cash flow statements, the budgets, all of that stuff, ultimately, those sorts of things need to fall on the owner so that they've got clarity on where this business is going, and then they have a team to transact all of that. But we've got to get away from this myth that I just let my accounting people handle all of that. It's like saying this, I let my doctor eat healthy for me. I let my pilot pack my parachute. Never check it. Or I let someone else raise my kids. Or in order for my life to be good, I let my banker make all my spending decisions. All those sound ridiculous, don't they? And yet that's ultimately what we're saying when we say, I let my accountant, my CPA, my bookkeeper handle all of my finances. A lot of us, we have this imposter syndrome to think that we're not smart enough, we're not good enough to be able to deal with the finances. In fact, we've been trained on this in our modern culture. Financial people have come to us and said, well, hold on, you're not fully understanding this. And then they go into this realm of complexity. Well, a lot of times what we found is the complexity actually is covering an inadequacy to some degree. At the end of the day, finances look like this. Total revenue minus total expenses equal net income. In its most basic form, that's how business works. That's how a profitable business works. And so lest you think you're not smart enough, if you can grab the concept, total revenue minus total expenses equal net income, then you may not need to run a business. But if you can get that concept, then you are perfectly positioned. But the issue is usually we're not paying close enough attention to it. I want to call us to illuminate the neglect so that we can steer our way to actually paying attention to the numbers. The truth to the cash flow problems in that myth is this, that most cash flow problems start with neglect. So let's go to our acronym of neglect and talk about what those issues usually are. The first is N, and that is that we have no subdivided bank accounts. So I'm going to put it in shorthand, but just pay attention to what I'm saying as we go through it. What do I mean by that? Most of our businesses run from 1, 2, or 3 bank accounts. Imagine this is kind of a popcorn bucket. In fact, I've got a whole video on this. If you click on the link in the description below and go to how to solve cash flow problems in a business, and we've got some tools and some walk you through there on how to subdivide your bank accounts. But here's the bottom line. When a dollar comes in, we as the owner and as a team need to cut that dollar up, because when a dollar comes in, our mind tells us that's all our dollar. But the reality is it's not. In fact, money has its own behavior. A dollar's not a dollar. A money in or dollar in is always less than a dollar. So if I get a dollar of receivable, I don't get to keep that dollar. And a dollar out is always more. So if I pay a dollar for something, I accept paying tax and other fees on top. So I pay more than a dollar. And so money has its own behavior, which means we need to take control of that tool rather than that tool taking control of us. And in order to do that, instead of one bank account, we need to subdivide this into 6, 7, 8, 9 different bank accounts. So when the dollar comes in, we cut that dollar up into these different homes so we know exactly what those or what that part of the dollar is deployed for. Capital expense, tax, operating expense, profit, owner's compensation, etc. The second cash flow problem that we tend to neglect is that our expenses are growing faster than our revenue. And so we've got to be very careful of this. And usually this is an emotional play, or it's a play that we did not count the costs before we got into a revenue opportunity. Some people, what they'll do is they'll go sell an up-level package of their service or their product, but not realize that their expense also up-levels with that, and they were banking on the old expense model to fund the new product offering. And so we're not aware of that. Or emotion comes into play for us around this, where what we'll do is we'll actually get into a new engagement, a new product that we've sold to a customer, and then we need people fast to fulfill that thing. And so we just go grab people. We pay more than we need to for those people, so our expenses start to increase, and it slowly outpaces our revenue. This is usually something we never walk into knowingly. Instead, what we do is we neglect this, and all of a sudden our expenses are increasing. The third way we neglect proper cash flow is we begin to guess. Oh, we get into such big problems guessing on things like pricing, guessing on things like profitability. And so we don't really know. We sell the thing, we start to fulfill the thing, we start to expense and pay out about the thing, but we really don't know if it was the right price and we don't know if it was the right profitability. There's a pretty easy way to go do this. I want you to take whatever it is that you sell per unit. It could be per customer per month, per customer per transaction, per whatever. Boil it down to unit. And then what you can do is you can run your entire P&L and upload it into AI and go, hey, AI, here's my P&L. Here's my expenses, my cost of goods, all that kind of stuff. And here's my product per unit per blank. Can you show me profitability, or what they call in the contractor space, job costing? Can you show me profitability per unit of what I sell, per hour, per minute, per widget, per whatever it might be? And you can come up with this so you can start to adjust your pricing so that your revenue can outpace your expenses rather than your expenses outpacing your revenue. And then when that revenue comes in, you can cut it all up so you've got radical clarity as to where you're going with that. The fourth element of neglect that leads to some of these cash flow problems, we begin to loosen or simply not follow up on our payment terms. And so we just get loose, we send a bill out, we send an invoice out, and we just don't really follow up with that thing. And then we get frustrated. God, I sent the invoice and they didn't pay us. God, they're truant clients. Now the reality is they probably just forgot, and you probably didn't remind them. Part of the process of a good accounting process that either you or some member of your team needs to do is not only sending the invoice, but following up with the invoice on a regular clip, 7 days out, 14 days out, 3 days reminder, whatever it might be, but there's got to be a cycle, and that cycle needs to be communicated to the client so they're not surprised when they get reminder about their payment terms. Just tell them this is a part of our process, that when we send you a bill, we're going to send you reminders for payment on that, all the way leading up to that. And unfortunately, if that bill is late, we will have to apply a late fee around that. Communicate that up front. And when you do that, you're going to have a better opportunity to tighten up your terms around getting paid instead of neglecting what causes cash flow problems by loosening those terms or just neglecting them altogether. That leads us into another area of neglect that causes these cash flow problems. And that is an empty awareness of our weekly position. What does that mean? Well, we have a weekly cash position. And if you had subdivided bank accounts, you could see it in the moment, at any time of day. And what an owner and leader in a business needs to do is they need to know their cash position at minimum on a weekly basis, because there's fluctuation that happens. It's what they call the flow of cash or cash flow. It's why you're here on this training video right now. And so what we can do to help augment that is we can have a hyper awareness as to our cash position on a regular basis. And one of the easiest ways to do that is to subdivide your cash accounts into 6, 7, 8 different cash accounts. That way, at any moment in our business right now, I could pull up our online bank account. I can tell you to the penny how much we have in profit, how much we have to pay the government, how much we have for our operating overhead and labor and payroll, how much we have for capital reinvestment, and we even have account for generosity, and there's a couple other accounts that we have. But I can tell you to the penny how much money we have in the accounts for those things right now. We have a hyper awareness that I look at weekly and get a report monthly to see where we're trending with all of those things. And so I can tell you a ballpark of what our revenue is, what our cost is, what our expenses are. Not because I'm an MBA, I'm not. Not because I'm a CPA or a CFP or some licensed financial credential. I am not. I am a business owner that simply pays attention. The C part of neglect that leads to this is this issue of poor cycle times. And so we look at this with a clock. And so it's that we look out and we go, hey, we're just assuming that 30-day payment terms are good. And even when it's 30 days and it goes over to 45 days, and if we get our money, we get our money, right? Well, no, what happens is payroll comes up every month, overhead comes up every month, like the clock is ticking. And so we've got to have that money coming in. And so your cycle times usually are too lenient for what you're doing, and you're okay with letting somebody be 1 month, 2 months, 3 months over for what they're doing. We've got to tighten those cycle times up, but we're afraid to do it. That's why it's got to be a part of your process. And that process leads into our final T, and that is this issue of tracking systematically. Too many of us do not have a systems mindset in how we run our business. What we have is we have a willy-nilly mindset. We have a kind of a throw it to the wolves mindset. We have a wake up and just throw this ball all over again, which is why we're constantly spinning plates. We're dropping balls all over the plate, is because we don't have a systematic approach to this. In fact, on this idea of systematization of the business, I want to refer you to another video that I've done. Go click on the link in the description below. It's entitled, What is an Operational Plan for the Business? And in it, I do a deep dive on this idea of systems, what we call the 4 Ps and the 4 core. And you want to make sure to walk through that so you can have a system to track the business that prevents against neglect. So in order to not neglect, what I want to do is I want to steer you out of this. All right, there's 3 different arms to the steering wheel that we're going to put in here, and then I'll give you a tool that I think will be really helpful for you. And it goes like this. It's subdivide, track, and review. That's our steering wheel, right? STR, subdivide your bank accounts up here, track this stuff to where you're looking at it and tracking systematically and you're hyper aware of what you're doing. And then to increase that awareness, I want you to start looking at these numbers every week. If you could just commit to that one thing, subdividing and tracking and reviewing every week, you'll start to steer your way out of these neglectful areas and push yourself into where you've got predictable cash flow rather than a problem with cash flow. All right, I've got a free gift for you that's going to help. And you and your team can walk through this together. Go click on the link below. solvecashflow.com is the link. There's a handbook that I've put together for you so that you can begin to methodically walk through how to solve this cash flow problem by subdividing your bank accounts, building the tracking sheets and all of that. And we've got incredible resources for you right there. solvecashflow.com. What it's going to do is position you so you can be liberated from cash flow chaos and make time for the things that matter most.